But it is possible to build a moat around that and incentivize investment in this space, which will not come at the Chinese prices because simply that's not economic. So price floors are absolutely necessary for this if we want to have any chance of rebuilding this sector.
Welcome to the Elements of Deep Sea Mining podcast. I'm your host, Eric Young. Joining me today is portfolio manager at Amvest Terraden Critical Minerals Fund, the author of Mineral War, China's Quest for Minerals, China's Quest for Weapons of Mineral Destruction. Came out in January this year. Former director at the World Economic Forum. He's spent over 15 years managing commodity and mining equity portfolios all over the world. And he's the host of the podcast Tyranny Today. Thanks for being here, Tomasz Nadrowski.
Thanks, Eric. It's a pleasure to be here with you.
So I think most podcasts start off with asking the guest to introduce themselves. I think that's to give people a little bit of confidence in your bona fides. You seem to be kind of an incredible polymath. So I'm not sure where to start. One of the things that comes through in your book is you've got expertise both in minerals and in Asia. And so which one of those came first? Did you start out interested in Asia and then the mineral expertise came after that?
Asia was first. I was always drawn to Asia. Ended up in Japan early in my life and studied there. I still have very strong connections to that part of the world. The first real job sent me to China. So that was almost inevitable back in the 90s, late 90s. You know, I've stayed in touch. I mean, I studied the culture and the religions and so on. So it became kind of my second nature. Half of my family is Asian too now. So it's the story. Minerals came later. Minerals came later. It was actually a quirk. You know, so many things in life happen by chance. We should never underestimate that in addition to agency and structure, there's this contingency. And that's exactly what happened. I worked at the World Economic Forum. Naturally, I was put on the Asian desk, given my background. And then one day, the forum changed the matrix from geographic to industrial. And this is late 90s, you know, great internet bubble. Everybody's going to new economy. And this young guy, what are we throwing at him? Well, let's just give him some minerals. Who cares, right? Like mining. Nobody knows it. I had no idea what it was. And then I delved into it and it was fascinating. This was one area which was so geographically determined like nothing else. You're either in one place or another. Everybody else can move factories around the world. And we are where we are, you know, even if it's in Sierra Leone. So it was a fascinating journey. I was very fortunate to be given an opportunity to learn the real thing by joining what used to be back then the world's largest mining conglomerate. And learn the hard way down in Africa. I always, when I speak to young people, leave always something to chance.
That's interesting. It's one of the things I've learned in doing this podcast because I get the opportunity to kind of ask everybody for a little bit of a backstory. And so many of those are just completely random. You know, I had a summer off and so I took a summer job here and it ended up being my career sort of
exactly.
thing. So,
yeah. True.
And yeah, it seems like, I mean, having first expertise in Asia and then the way the minerals market has kind of shifted in the last, I don't know how many years you would put that it's become so dominated by China and Asia. That I guess was also just a bit fortuitous that your cultural expertise happened to be so useful also in the industry that you were kind of thrown into.
Yeah, it's a confluence of factors. As you say, fortuitous. The Chinese dominance is still fairly recent. We're really talking about the last maybe 15 years or so. So since the end of the super cycle and after the great financial crisis, this is not something that the industry could foresee. Now, this has been or had been for decades an industry very dominated by Anglo-Saxon companies, large London-listed companies, some Australian, some Canadian, to a lesser extent American. And so I think in our sort of Anglo-Saxon world, we thought that, you know, that's sort of a safe bet. We will continue to dominate those spaces with properly structured markets for more liquid commodities, both in London and LME and COMEX and other exchanges. And, it just evolved very differently for starting with those smaller markets and then expanding slowly to the largest markets as well. This completely different rationale has been adopted by the main source of demand for these products, which is China.
Okay, so let's just jump into your book. And I mean, this probably ties to what you're doing now, but start off with why you felt like you needed to spend your time writing a book and this book right now?
Surprising little time to write a book. It doesn't take much time to write it. It takes a lot of time to edit this and publish and then market. That's a different story. It's completely new to me. New to me because on day-to-day basis, I'm a fund manager. I'm portfolio manager of a fund. That's what I do. And when you do it and you're not independently ultra wealthy, you're running someone else's money. You're managing someone else's money. You have to constantly attract someone else's money. And that process has proven to be rather fraught. Most people don't understand what critical minerals are. They don't understand these markets. They're tiny. They're peripheral. They're definitely very niche-y, at least in the context of the US capital market. So I thought I have to actually explain to people what it's about, why it matters, and why there is an opportunity to derive value from scarcity.
Has the book helped with that? Or, I mean, sometimes I imagine that the process of writing a book is you're going to practice putting it down all your arguments in a structured way, and then one of the benefits is now you can make those arguments more clearly in person. But do you feel like the book is having an impact? How has it been received?
It has been actually surprisingly well received. At some point, for a nanosecond, it was, I think, #1 bestseller in Australia. Other than that, nice. Ranked highly in sort of energy category on Amazon and so on worldwide. It is probably the different reason for that. Mining industry has had a number of books thrown at it over the last, say, decade and a half, written usually by people from outside of the industry, and usually, how would I put it, not necessarily entirely friendly towards the industry for a variety of reasons. Obviously, one of the most obvious reasons, this is not a benign industry. And therefore, I think there's a certain fatigue that here's another one about, child labor or environmental externalities or this or that, written by journalists who just come to a mine and see a stockpile for the first time. So I think there was maybe hunger for a book that actually treats this from more of the insight from the operating industry and insight from the financial industry that backs it up. And so, not surprisingly, popular in Australia or Canada, which are par excellence mining countries.
Cool. So I saw that this book thoroughly covers the kind of statement of fact that China is dominating critical mineral supply chains. And you give a lot of detail on that and context. But for this podcast, I'm going to assume that the listeners sort of either buy that story or they are open to it, that we can kind of skip over that if people want to understand to what extent China is dominating at which sort of points in the supply chain and which minerals. All that information is in Thomas's book. And so I really recommend that people check that out because it's super useful context. But yeah, for this conversation, I would like to focus on what to me was the most interesting and valuable part of this book, which was essentially why is China dominating these things? Why is China able to dominate markets, whereas the West, traditionally kind of the market dominant free market strength, is just falling further and further behind. And you put a lot of arguments and theory and structure to that. So let's just jump right in there. Why doesn't the free market work for critical minerals?
You see, Eric, in order to answer this question, we have to define what free market is. And
go on.
Go ahead. Tell me.
Well, I often think about this in terms of just like the simple Econ 101 supply demand figure. And it's like, okay, well, everywhere we sort of assume that aside from a few market failures that people are pretty well aware of, when you have enough demand, supply is going to get there. And then critical minerals seems to have a different story. The story that I've been kind of dwelling on for the last 5 years is like, well, for some reason, China is able to look farther into the future than the West. And I thought this was just like a political thing. We have short investment cycles. We've got short political cycles. They have the ability to make 5 and 15 and 50-year plans. But then I read your book and I saw, there's much more market dynamics here that I'm not aware of. So explain a little bit, maybe from Econ 101 for people like me who don't really understand finance and markets. Like, why is it that we can't just rely on the price to supply the minerals?
I love this question because the answer is not going to come from finance and markets per se. It's going to come from the legal framework that a market requires. And the legal framework that we know in our free market economies goes back to late 16th century, early 17th century, where contract law was created eminently in the West. It's called School of Salamanca, happened to be in Spain. And so these people managed to fuse what was known as natural law, so Thomist scholastic tradition, with a consensual contractualism that was embedded in the way markets were created in Europe, independently by the fact that cities, towns, were centers of exchanges. That's not the case anywhere else. It's not the case anywhere else because of inherent nepotism in other cultures. There traditionally, trust does not go beyond the confines of the clan. That system was so successful, and afterwards, different economies in Europe ran with it, starting, of course, with capitalist Venice, and then Netherlands, and then Britain, and its own common law variety thereof. But the contract law was absolutely critical to embed and extend the networks of trust beyond people that you know from your personal experience. That's just not the case in other traditions. It's not the case in the Islamic tradition. It's not the case in the Chinese tradition, or broadly Sino-centric tradition, and so on. And so we have that approach in our Western world, that somehow this is the best system, and with this best system, wealth has been created. And true, it has been created. But wealth can also be destroyed. And often wealth is destroyed not at all by free market or market dynamics, but by security issues, by insecurity. And fear is often a bigger driver than greed, and we should not underestimate it. So just like market dogmatism does not explain everything in our life, nor does security, nor does science, nor art, nor philosophy, nor religion. There is space for each of those. And I think we just sometimes, depending on our personal walk of life, are too connected and too chained to a specific form of explanation. Let me come back to from this to the Chinese case. Security is the most important driver. Security of the regime and remaining in power is what matters. And everything else is just a tool for the regime to stay in power. I explained it in the book that there are more or less three major pillars of that grand strategy. One related to territorial claims, one related to acceptability of this form of government around the world, and one related to unwinding of the economic imbalances accumulated throughout the 35 years of massive leverage in that economy. In all of these, that leads to conflict. And in all of these, you need leverage in order to win over the conflict. Now, monopolization of certain sectors allows you to use that leverage. Why has critical mineral market become monopolized, which is a structural question? And it's a good question because you have some other cases of other sectors and other supply chains that have not been easily monopolized. Well, the reason lies behind the nature of the value chains in mining in general. Margins are extremely high at the source, so at the production level of primary material, and at the final market, closer to the customer. So let's say iron ore mining and structured steel, advanced structured steel, but nothing in the middle. In the middle, usually you have very low margins, and the same with diamonds, and the same with gold, and the same with critical minerals. Why is smelting and refining? Yeah, smelting and refining generally needs a lot of volume because of a nature of payabilities and nature of relationship between the miners and the smelters. So most of the net smelter value is retained by the miner simply because mining deals with wasting assets. Smelter doesn't, as long as you can secure feedstock. So it's this kind of a smile in the margins, and so you have to really control a lot of volume. Well, if your political decision is that you need a lot of metal for whatever other reasons often typical for those large authoritarian regimes, Stalinist regime paid a lot of attention to this, then naturally you're going to build up a lot of volume. If your competitor does not have the volume, then it doesn't make any sense to run money-losing high fixed cost smelter or refining. And so that's from the center of that value chain that the migration of the sector starts. Now, of course, there are different parts to this, whether you can actually control it vertically through transition pricing between different nodes on the supply chain. And this is where the critical mineral space seems to be directing right now. So that's a fairly new development, but it's something that could actually save the midstream part of the supply chain. So that's, apologies for the lengthy explanation.
Well, I mean, I love that framing of it's prioritizing different variables is kind of what I took. That the Chinese are, in this case, prioritizing security and, I guess, security of power. Whereas it seems to me that the free market is kind of designed that everybody can prioritize their own priorities, and that trade and price is going to just do the work of deciding who gets what according to their priorities. Whoever wants something more is going to pay more for it, or whoever is able to get it. And so
this is correct. So our view is that the value is created at the moment of exchange. I sell you something because I believe that what you pay me is above my costs and it's going to just generate more value, and you purchase it because you're of your marginal utility for that product. And therefore, the value of the capital goods that led to the creation of this product is generated at the moment of exchange. And likewise, the value of the economic factor that's beyond those capital goods is also generated by that flow from the moment of exchange. Friedrich Engels and Marxists don't believe in that. They believe that you have to infuse economic factors, predominantly labor, into the productive force, and that generates the value. Nobody asks, okay, so what if you don't sell it? But the reality is you have to sell it somewhere. And today China sells it outside of China because there is no consumption, sufficient consumption inside that economy, which is tragic for the rest of the world because of those embedded imbalances that lead to all the friction and all the conflict around the world.
And just, if I can just keep following your explanation here for my understanding. So China is prioritizing these security, and like you say, the middle of the value chain is where the lowest margins are. So that's why it was kind of those middle steps, the processing that China kind of acquired first because they wanted to have that security. Whereas in the West, we were happy to get rid of the low margin. Nobody was really prioritizing, like needing to have that domestically. And then now we've, I guess, a little bit woken up that China is sitting on so much of the supply chain.
And again, some of that concentration of smelting, refining was also not so much by design, but because of the nature of market opening in the 1990s in the Chinese economy, which I observed firsthand back then. These were the special economic zones, so little islands where you could actually infuse foreign capital, often Hong Kong, Japanese, Korean, Taiwanese capital, and technology. That means that spatially, many operations are co-located together. And I explained it in my book. Often it's highly beneficial from the perspective of not only just permitting, but in terms of the circulation of both byproducts and waste products that can be beneficiated further. So let's say you have a steel plant and a chemical plant and a graphite sterilization plant and all of this, dealing with, for example, movement of toxic material over very limited space. It's extremely beneficial. And so that helped with building those conglomerates that can actually deal with very high volume. It's extremely difficult to replicate it outside of China, I have to say.
That was another thing that I really appreciated about your book was that it wasn't just like, okay, there's one explanation for this. It's like there's a whole bunch of different contextual factors that all piece together at different times. And I think that is, that's something that I'm trying to bring to the deep sea mining conversation, is that you can't just kind of take one cookie cutter explanation for the way the world works and say, this is how it's going to be. And then if we can replicate that in this new domain, then that's also how the world is going to be. That the details really matter, and the context matters, and the nuance matters, and you've got to get down into those levels.
That's why multi-factor models, linear multi-factor models actually help with decision making often, right? Because it's good predictive statistics if you can get the weightings properly in those different factors overall. But these are multiple factors, not just one.
Okay, so then staying with this kind of how can the West overcome its challenges? I guess one of the main kind of stories I got from your book is that we have a problem of capital supply into these sectors. We all kind of agree that it would be nice if we had more mining and more processing and things domestically, but we're having trouble incentivizing the capital to support these initiatives. And so, how do you get the financial incentives back over into this.
Yeah, this is very complex. At the same time, quite simple. We have to step back and look at the actual structure of the industry, say mining industry, and the capital structure of the mining industry. How does someone get something off the ground? Well, usually by finding something and doing some geochemistry and geophysics, and then drilling it out, and then building a resource base, and then converting it into reserves, and then going to final investment decision. Throughout this process, the only source of capital is equity, and essentially mostly public equity, Australian or Canadian most of the time. Not so much US, at least not until recently. Meanwhile, the largest pool of equity capital around the world is the United States. Over 70% of global equity market is here. And so we have to connect these two dots. The pre-existing nature of the capital base, risk capital base for these mining ventures around the world, outside of the Chinese value chain on the one hand, and the lack of interest or myopia of the Western or American capital market that just hasn't seen enough incentive to go into the space, which is complex. It's complex in terms of supply chain connectivity. It's long-term, so it's long duration, not necessarily very attractive in higher interest rates environment. And it's difficult to run on a RV basis, relative value basis. Why? Because geology is always different. That's what makes it quite radically different from, say, oil and gas. I find it fascinating. I love working on inorganic chemistry of hundreds of different small acronyms in the table of elements. But the US has had a lot more success with just the C's and the H's, right, in the organic part of the extraction. And so the timelines and the capex intensity and the sense of risk and jurisdictional risk are just completely different. It was not always like that. It was not always like that. And I repeat, I started my mining career at a company known as Anglo-American. The reason why it was called Anglo-American over 100 years ago, was that not because it was in America or England, it was down in Africa. But the investors were American and British, and that's hence the name. And so there was a completely different appreciation of risk back then by the US investors that right now. And so the overall flow of material, of capital into ETFs that cannot finance mining projects, or into private equity that cannot do proper relative value cookie cutter thing that they can do for real estate or even for oil and gas, that prevents us from actually matching the capital needs of this industry with what the financial market is providing.
I guess you're making this bet because you are a fund manager in this space, that this space can be profitable if done well. I would have thought that there was part of this is just that because China is willing to keep prices low in this upstream and midstream part of the value chain, that kind of in an open market competition, there's just not going to be return on investment necessarily to build out a nickel refinery in the US or a rare earths refinery in the US, because China will always just keep the prices down.
Mm-hmm. That's true. But China keeps the prices down because these are inputs for domestic production of something with value added, and that gets exported. And I explain in my book little quirk to the tax system in China that favors exports of those downstream products, but not the midstream or commodities, or even finite commodity products. So this material enters China and ends in that sink. And it only exits in industrial goods downstream, often consumer goods. So, that's sort of a premeditated policy there. In terms of the price, this is true. The prices are low, but also the Chinese market is oversupplied with many of these products. And therefore, there is no reason for the Western producers or Western investors to model the value of their projects on the back of the Chinese prices. There was a reason for that, but not since China decided to weaponize it, right? Why would we accept prices based on a very, very elastic, almost horizontal demand curve in Guangzhou, Jiangxi province? There's no reason to do this if the material is not freely available to us. So price floors are absolutely necessary. I saw the G7 just had a meeting over the weekend, and they failed to agree on price floors. Always a question, who's going to pay for it? Well, in a single jurisdiction, it's easy. You set tariffs not on a country, but on a specific product, on a specific HS code. And from then, you generate sufficient revenue to support those prices. Once you get 7 G7 countries, or 20 or 30 or 40, it becomes a little more complex because you need a lot of bilateral arrangements. But it is possible to build a moat around that and incentivize investment in this space, which will not come at the Chinese prices because simply that's not economic. So price floors are absolutely necessary for this if we want to have any chance of rebuilding this sector.
So that means implementing some separate market, if I understand.
But it already is a separate market. It's a separate market the moment China introduced export control in 2020, and then subsequent restrictions, of which I counted 24 different restrictions until end of 2025, and it doesn't count the current new slew of restrictions that affect Japan and other partners. It already is the case that this is a bifurcated market. The question is, at which point will equity of Western companies reflect the potential price floor? Why does it matter? It matters because in mining we have 3 different prices. We have the 3 different costs. We have the operating margin costs, so for an operating facility. Then we have the capex cost for the initial project, and we have stay in business capital, so maintenance capital, because it's a wasting asset business, and you have to constantly redeploy capital to make it work, whether it's open pit or underground in a different way. But there's constantly capital that's spent over and above that operating margin. So you have those 3 levels. Well, what China does really well when it succeeds in monopolizing another sector, as it did, for example, with APIs, pharmaceuticals, is that it drops the price below its margin, and the dominant Chinese companies take a loss during this time. Sometimes they are subsidized. And of course, say a German company is going to die because it cannot compete against it. And then they raise it just enough to run a positive operating margin, but not sufficiently to incentivize a renewed investment overseas, say in Germany or Canada or somewhere else, to rebuild it. And if that process takes a long time, say a decade and so on, you lose human capital, people retire, and you lose institutional memory, you don't know how to rebuild it anymore. And that happened in several sectors, of which critical minerals is the one that I specialize in, but that's not the only one.
So it sounds like partly what you're describing here is that China has an advantage in managing the coordination problem within its own sort of domestic industrial supply chain, industrial ecosystem. Whereas in the rest of the world, we're relying on prices to coordinate our value chains. And in this case, China is sort of exploiting that signal that we use. And we're not very good at coordinating if you take away just like price as the main signal that we're all going to use to coordinate. Otherwise, we have to make agreements. And like you say, we're unable to come up with something like a price floor, which would be a coordination.
Yeah, but from a perspective of just commercial rationality, and let's stay on this side for a moment, what we're doing is rational. So prices costs should determine the supply and demand, even in an oligopolistic competition. The problem with the Chinese approach is that it's not free. It costs a lot. And what is this cost? It's a massive burden of over leverage in that economy. That's 360% debt to GDP. There's no way this economy can ever dig itself out of that hole. So it's not for free. We just determined earlier in the conversation, the rationale is not commercial. It's related to the security of the regime that stays in power, no matter what it costs. But the economy is now suffering from this huge burden, and it's extremely difficult to see how they can unwind it short of massive changes, fiscal reform, so unwinding of 94 fiscal reform, inflation, which is really not palatable for a totalitarian police state. We know it. Take Iran, for example, or Tiananmen, the most recent example in China. So inflation, you cannot reflate that. You probably cannot really grow at 10% anymore to really grow yourself out of that. So you keep adding to that burden every year. You might maybe try and move your resources from production to consumption as Japan did over 20 years. But of course, at the massive cost of stagnation for 20 years, it's very unlikely that the CCP allows for this to happen. So the only thing that's left is borrowing external demand. borrowing foreign demand. And that, of course, leads to all the conflicts and the problems of deindustrialization in the global south right now, as we call it, the China shock V2.
Explain that a little bit more, because it sounded like when you said borrowing external demand, I thought, okay, well, that makes a little bit of security here, that maybe this is a bit of an explanation why China is unable to just shut the tap off because they're so dependent on that external demand. But then you said we're talking developing countries. And so maybe that's actually not very comforting for that kind of strategic quest.
It definitely shouldn't be comforting to anybody. I'll give you just a couple of examples what happened since COVID. So 2020, right? This is a massive shift. So in 2018, US was trying to negotiate some rebalancing of that lopsided relationship, the massive current account surplus that China has had. And they reached an agreement. And of course, China never really complied with the agreement. And then we have the pandemic 2 years later. Since that pandemic, Chinese consumption, domestic consumption, is trending below its trajectory and its production above its trajectory, pre-pandemic trajectory. What does it mean? It means that essentially most of that current account surplus that focused on the ultimate demand sink in the global economy, there's the United States, has just shifted somewhere else. So since 2020, European Union has suffered a 74% deterioration in their current account balance vis-a-vis China. If you think that's bad, then think about Asian countries in Southeast Asia. 6 times higher current account surplus, China's current account surplus vis-a-vis Asian countries. Africa, 6 times higher as well. It's just a massive burden from which these countries probably cannot really dig themselves out unless they can generate some political will to push back, as US did. And to some extent, we reduced that from 300 billion to I think from 450 to about 300 billion. But China's overall current account surplus has grown from 300 to 735 last year, overall, globally. If you're a small economy, I'm originally from Switzerland, so a small economy like Switzerland generally generates about 50 cents per Swiss franc from exports. But it's a tiny, tiny part of the global economy. It doesn't have domestic market that can carry this. But if you're an economy that represents 17% of global GDP and then 35% of global manufacturing, and according to the fourth plenum of last year is planning to go to 40 or 45% of global manufacturing, there's not going to be any global manufacturing left anywhere else in the world. And that's not what David Ricardo told us in, comparative advantage. The comparative advantage was on the relative value. It wasn't the story that Britain would produce both wine and textile, if you remember this from the textbook. It was that even if Britain is more efficient in both, it's the difference, relative difference in the efficiency, productivity between Britain and Portugal that allow it to focus on the one where the gap is larger and where the gap is smaller. Portugal will produce something. China's approach, Xi Jinping's approach called Shuangxunhuan, dual circulation, completely subverts the system. Chinese economy is supposed to become ultimately independent of the global system, and the world system should be dependent on China. And that critical minerals actually lead it directly in this direction.
Okay, so I guess I have to ask to try to bring this down for the average person who is sort of aware that there's a critical mineral imbalance and that this is potentially going to be a problem. Can you kind of put a specific point on, like, what is that problem going to be? What is it that we're actually worried about? Like, why can't we just let China be the manufacturer of all the critical minerals and we'll just buy them from them at their depressed prices and carry on with our lives?
Mm-hmm. Yeah. So this is really the key point. What's the problem with monopoly? In commodities, there are a lot of monopolies, right? There are a lot of monopolies because when, God created the geology of this planet, it didn't necessarily correlate very well with our decisions where the borders should be, right? So I worked in South Africa for a long time, and here we are, a platinum monopoly. Was it any problem for catalytic converters over, 40 years of cleaning up our ICs? Not really. You can be a monopoly and still sell it and, happily. So in commodities, this does happen. Indeed, you know what? It happened in rare earths. The United States was a monopoly in rare earths in 1960s, 1970s. In fact, myself growing up in Europe, the first TV set that I had with colors was a Sony. So it was a Japanese color TV. And for those beautiful red colors to be so nicely projected and show us our old, Technicolor movies, we used europium, a rare earth element from California, from Mountain Pass mine. So US was a monopoly, but a Japanese company could produce those TV sets with a US product. Today, Japan cannot produce anything with rare earths from China because China protects its market. It's not about monopoly per se. It's about weaponization of that monopoly. It's about restriction upon restriction upon restriction affecting about 12 different minerals, of which rare earths I count as one. So 12 plus, 16, or maybe less than 16 because 7 plus 5 have been really controlled by China for exports. Restrictions concerning specific materials and their components and alloys, as well as technologies to produce them, technologies to separate them, sometimes technologies to extract them, as in the case of lithium, direct lithium extraction, as well as equipment to produce it, related IP, technology, reagents, all of this stuff. So it is really about weaponization. So if I can buy this product cheaply, and many OEMs, and I was just at a conference in Germany and spoke to, a famous German car maker who says, we're going to just buy what's cheap. We're going to buy, what's the lowest price. And that's it. That's the problem. The procurement department will do exactly what you're saying. They're going to still buying this material from the cheapest source, in this case, China, which is going to just subvert all of our efforts to rebuild this value chain in the West. And China will allow them, provided they can give them a full data set concerning their own use, their own customers. There cannot be any slight whiff of dual use application for these materials, say permanent rare earth permanent magnets, and they are not allowed to stockpile. So that's the rule today. That's what I call weaponization. It has nothing to do with monopoly as such.
Yeah. So, China is using their large market control to get even more market control. Like, has this become a real problem? And I'm always kind of looking for like the smoking gun in terms of, okay, this was the case where there was a really crucial need for some mineral and the black market or the just paying a high price for it wasn't able to supply that. Has that happened yet, or is that something we're essentially worried about in the future?
So, of course, I don't know exactly who's smuggling what through the border of Myanmar. I wish I did, but I don't. All I can say is that there is a bifurcation in the prices already. The prices in the West, such as those that we observe in the warehouse in Rotterdam, they're not based on huge volumes. But say yttrium last year, one of the rare earth elements, just went completely through the roof. It didn't move in China. Tungsten, which is not a rare earth element, but an important metal, has seen a similar bifurcation as well. And so we are seeing already this effect that there is, because of lack of availability of some of these products outside of China, their prices really react to this. Now, is there smuggling? I'm sure there is, yes.
But is there the case where there's a crucial application that isn't able to get its hand? Because that's at the end of the day, that's the real problem here, is that if China at some point says, no, you can't have that rare earth element for that defensive missile guided control system, that's what we're really worried about at the end of the day. If at the end of the day, China says, no, sorry, Toyota, you can't have rare earth elements for your Prius, like, okay, well, either we're all going to end up driving BYDs or we're going to have cars with poorer range or heavier. And maybe that's something, like, coming back to my Econ 101, it's like, okay, well, maybe the market is just going to absorb that.
Yeah, very good point. So I gave you an example of yttrium. What do we need yttrium for? Essentially for three things. One is yttrium stabilized zirconia, which is this thermal barrier with which you coat jet engine or rocket engines. One is yttrium iron garnet, a laser, solid laser. It's used for electromagnetic warfare, so dual use application. And one is yttrium aluminum garnet, which is part of the etching system within the semiconductor production. So 1.5 out of 3 are dual use, military use. Good reason for China to restrict them. If I were to really freak out about one element right now, it would be probably gadolinium, and that's because of how many missiles we expended in the Middle East this year, and what it means for electromagnetic warfare and the coding. And gadolinium is critical for this. Right now in the West, nobody separates gadolinium, although there are some leaks that someone in Japan is capable to extract it, probably from secondary sources or some dirty concentrate, but not on a massive commercial scale.
And so, like, is the price of gadolinium, like, is the U.S. defense contractors struggling to get a hold of that?
The real story here is that if you have forward stockpiling by defense contractors, you can be sure that they're going to bid up the price, compared to, say, commercial needs, right? So that's one thing that we will see sooner rather than later, despite the fact that it's going to take, 36 months or 40 months to replace those arsenals. But the stockpiling will definitely be bid up price-wise.
And then I guess I have this other question about a lot of these metals are relatively small markets, right? And I'm sure you got the numbers off the top of your head, like how many $1 billion is heavy rare earths market. And in these cases that are extremely strategically important, but relatively small, I often think, okay, like, isn't that within just the strategic budget of the US to just say, okay, we're just going to gut it out and make a domestic supply chain. We'll pay that $6 billion to not be exposed to this. Can you understand what I'm getting at?
Yeah, I see that. So the problem is definitely technology and people and knowledge. And by the way, if you're one of those tens of thousands of engineers dealing with that, say, as a separation of rare earths in China, you're not going to get a passport to travel, right? So it's difficult to obtain that knowledge at the current sort of generation of this technology. There is some memory, mostly in France, interestingly enough, but it is really not a problem of money. Now, when it comes to money, the entire rare earth element oxide market at the beginning of this year was about $6 billion, so really tiny. But as we know from various studies, the downstream impact of not having access to these materials, especially for permanent magnets, is about $10 trillion. It's completely different value. So that's where leverage is coming from, really. Not so much from the actual loss of margin by Chinese private exporters. They can definitely swallow that loss, but the unavailability of the material downstream is critical.
So one of the things that I see as a problem, and you mentioned it in your book, is the structure of mining exploration, that it's done by junior mining companies, and that those are kind of, the funding around that is very speculative, I understand. And so I was just rereading a section before we started, and it popped in my mind to ask you about, like, alternate models for that exploration phase. Why isn't it that the big companies kind of go farther upstream into the exploration phase? And wouldn't that be a solution to some of the problems that come around in having kind of an insecure exploration phase of the value chain?
Yeah, it used to be like this. Large mining houses, as we used to call them back then, were everything. There were investment houses, there were explorers, there were miners, there were smelters, there were refiners, there were traders. They did all of this thing. And that sort of began to unravel probably in 1980s. So first, we saw a separation between mining of minerals and mining of energy assets. So say, coal used to be part of sometimes oil and gas companies. So that there was a separation there. And then a sort of increased specialization in a specific node. So in many cases today, a mine is not built by the mining company. It's mined by a contractor, right? And an EPC or APCM contractor, which is a separate company. Very few mining companies are mine builders. Because what do you do when you have that, team and you're not building anything new, right? And it's similar with exploration. Somehow in the 90s and then during the super cycle, the conviction was that small juniors being sort of fleet of foot, flexible, can actually be more successful in going into often risky jurisdictions than sort of those top-heavy, large mining companies. That, of course, came with a higher cost of capital, but it didn't matter during the super cycle because the prices of commodities continued to ramp up. The moment that was over, of course, the entire project collapsed. And if anything, I see it, and I think I quote it in my book, in the sort of attrition of mining equity investment, fund investment business that, had a selective sort of specialist portfolios, including junior miners. And that was completely obliterated during that decade between, say, 2011, 2023-ish, both in London, Canada, to a lesser extent in Australia as well. So the space became too cyclical, too exposed to the whims of capital cycles, while the adversary, a competitor at that time maybe, didn't have cyclical capital because it's all sort of provided at the end of the day by state-owned banks, right? As I said, at a huge eventually a huge cost for the economy, Chinese economy, but at a low cost of capital or underpriced capital, below inflation and below GDP is one of the problems of competitiveness of those ventures when they go, say, to Africa or other countries to invest and compete against juniors, because they have most of the risks covered, the commodity risk, the cyclicality risk, the jurisdictional risk often covered by sort of government to government relations, and the offtake risk as well, because they mostly go there as SPVs connected to downstream, midstream refiners or smelters back in China. The material never goes into the open market. It never ends, say, London Metal Exchange or something like this. So it's an off market. So the whole effort is just to take away the cyclicality of the market. Meanwhile, the junior market is so hugely dependent on those wave of interest. And the most recent bear market was between 22, 23, 24, and it killed a lot of projects, some of which may be even viable.
So is there any chance of a move back towards having integrated juniors with more security and less kind of dependence on the?
So they will depend on the decisions, the big boards of the large mining companies. It doesn't mean that they don't have exploration, but very little in the way of large discoveries have been made by those large companies. They usually simply acquire those really attractive project generators. So sort of that separation of different roles that may take a little longer to be fused again. I think in the specific critical minerals that are most exposed to the weaponization, it's probably necessary because, again, what we started with, the differential margins and just the problems of transfer pricing if we have to recreate the price environment anew in the West. And so that calls for some form of consolidation. And the issue here is that in most of these sectors, there is no natural consolidator. I mean, who's the major Western company mining tungsten? There's now one mid-sized company operating in Korea and the Iberian belt, but the reality is that there isn't a natural consolidator in antimony or tungsten, or not to mention byproducts like gallium and germanium, or even in rare earths. This is probably changing, but the large players are simply not in this space. The largest that there is Rio Tinto, which has a significant lithium exposure, and so they potentially are active as lithium consolidator, but nothing beyond that.
Okay, let's shift just a little bit to focusing on what you do with your fund. So your fund, I understand, focuses on essentially this problem. You're trying to bring capital into some of these mineral supply chains, and you don't invest in, you just don't invest in China?
Well, investing in China is increasingly difficult. First, proper due diligence is illegal because it concerns, state secrets. So you cannot really go and dig around or visit a mine or do anything like this. So there's a massive risk investing in something you don't know. And secondly, you imagine you invest in, a Chinese company, some of which are good miners, right? And excellent refiners. So just for that reason, you want to invest in this. And the next morning you wake up and the government tells that company that it's not allowed to export X something. And therefore, they're condemned to the local, benthic level prices. Not a great way to invest. So I'd rather invest in something that I can understand, which is, across the non-Chinese value chain, and something where I have access to informationally and management and so on.
Yeah, so that wasn't like an ethical decision. Your fund isn't trying to solve this strategic supply chain problem for the US. It's that you are using your expertise in these markets, and you kind of choose not to invest in China because that's actually not a very good investment. I guess, first of all, what is the specific focus of your fund, and what made you kind of constrain it where you have?
Yeah, so the fund invests in equity of mining and processing companies around the world. Essentially 3 different buckets. So rare earths is one bucket. Specialty metals, many of those with dual use application or semiconductor applications. There's the second one. And third one is battery materials. And so alongside, we have probably exposure to about 20 of different commodities, counting rare earths as one, across different jurisdictions. A lot of Australian companies, Canadian, some European, UK, US, Japan listed companies as well. We are mostly in the liquid market, so secondary market, but we also have exposure to pre-IPO opportunities, provided they make sense from the perspective of sort of dovetailing within this rejuvenating value chain, if you wish. So they have to make sense in terms of, downstream connectivity. And likewise, a midstream operator has to have secured feedstock from somewhere, at least, within sort of visible time horizon of 5 years or so. So that's what we do. We find it a fascinating space. You have to pay a lot of attention to substitution risk and substitution opportunity, especially in the civilian market and semiconductor space that changes really fast. And you're right, many of these sectors are small. So the idea here is to identify those few players that will be sort of the first through the finishing line, because sooner or later we will be able to rebuild those value chains. Just the question is how quickly and who the winners are.
Okay, because people often frame this critical minerals crisis, let's say, as a geostrategic problem. A lot of your book says we have a problem getting capital into these supply chains, and that's creating a problem that's a strategic problem. It's not necessarily just an economic problem. And so there's like a, call it altruistic aspect to that. Like your fund is solving the problem that your book is pointing to. But it seems like what you're telling me is that you're doing that from a profit maximization point. You're not kneecapping yourself.
Isn't that a false dichotomy? Can't we just do both?
Yeah. I mean, that's great. And I think the general conversation around critical minerals is that China is keeping the prices down. Part of that, the standard narrative is that they are willing to accept many more environmental and social externalities. So we'll never get our prices to match theirs. And that the implicit solution is we need to bring non-market solutions. And so I just think it was very interesting to hear that, no, actually you guys are in this for just fully market solutions, and you see that there's money to be made here if you know specifically where to look and how to
yeah, and this is I've been investing in mining and mining equities for 20 years now, and I hardly ever had that sort of strategic visibility of the thesis that we know that unless something dramatic happens and we go back to globalization, years of cooperation, competition, and kumbaya. Unless that happens, for now, the reality is that we are in this bifurcating market, and there is an opportunity here in this bifurcating market. Why? Because if I were to compare this specific set of events and set of decisions by the Chinese Communist Party, in market terms, it's actually similar to the OPEC embargo in 1973, because this was the other case of monopoly or quasi-monopoly at that time, weaponized against the Western world. And where has it led us over the last 50 years or so? Of course, it gave us a petrodollar first, but also it increased massively energy efficiency, right? Instead of running 13 miles a gallon today in an ICE car, you do twice as much, 25 or something like that, right? So massive transformation, technological and economic and so on. And I think something similar is going to happen here, not because of, as I repeat, the value of those materials per se, but what they represent in the final application in the economy, how important they are. Okay,
then let me ask you about ethics. So I am, in theory, right now writing a PhD dissertation I'm early into writing a PhD dissertation on the ethics of critical mineral supply chains. Where do you think ethics fits into your conception of mining and minerals?
Well, ethics in mining, I know it only firsthand from being a mining executive in the company that had to project its reserve replacement. I repeat, wasting assets. You have to replace your reserves over a long period of time in very exotic jurisdictions. And that meant that we had to engage with people, which gave me a wonderful opportunity in my life to be with people in very different places where no tourist ever sets a foot, and learning how we can actually define economic value for what is a finite asset. And so we have to leapfrog that problem of the finality of assets and create value for people who inhabit that terrain beyond the actual value of the wasting asset. And then you have to, of course, finance that. So that's the number one constraint, in addition, of course, to negative externalities and all other things that we know that, market usually won't pay for, and there's too much arbitrage concerning that. But if you're running a mining company and you're stuck in some place for the next 15 years, you better figure that one out too.
So I have come to start equating ethics broadly with just like having a very wide boundary view of a problem, whereas economists look at the economics, and an environmental scientist might look at certain environmental factors, and ethicists should look at all of the different factors and how they trade off between one another. And so I've trying to ask all of my podcast guests, how do you make decisions? And I mean, we've been talking about this throughout the conversation, but just to put a specific question on, how do you make a decision where you have to balance between multiple different value categories that don't necessarily equate on a similar scale?
So very basic approach for me. That value hierarchy will change depending on the social operating system we're in. If we're in a social operating system based on cooperation, it's a different hierarchy. If we're in a social operating system based on competition, it's a different one. And if we are in a social operating system based on conflict, which is unfortunately the case of 2020s, it's going to be a different value hierarchy. And here, security will come way above everything else. And what Xi Jinping calls fento, struggle, so survival, because of their sort of Spencerian 19th century input that the Chinese thinking had about economics. So it's just depends on in which context we are. And I think a major mistake for people who say have grown up in one type of social economic organizing model is not to recognize that we shifted to something else. It's definitely the case in this decade.
That's very interesting and a different answer than anyone has given me so far. In the deep sea mining conversation, there's a lot of talk about the framing of this conflict with China being the main adversary, etc. Obviously, your book is called Mineral War, and you lay out that framing. I think a number of people are skeptical that we should be taking an adversarial approach. You also kind of mentioned this in your book, some quote about if we treat China like an enemy, then they'll become an enemy. So just for people who are skeptical that there really is a conflict here, can you kind of make the argument that we're in a new paradigm?
Yeah. So please allow me to give you a little more of a philosophical answer here. The question of being or not being adversary is not a first-person event. It's a second-person event. It's a third-person event. There was this philosopher in France. His name was Julien Freud. Julien Freud was a scholar of Max Weber and Carl Schmitt. And of course, Schmitt is usually quoted as this ultimate philosopher of conflict, very popular in Moscow, very popular in Renmin Daxue in Beijing, less so in the West. But Julien Freud said one thing. If Eric decides that there is no conflict between Eric and Thomas, but Thomas decides that there is a conflict, that Eric is Thomas's adversary, then regardless of what Eric thinks, there is a conflict. And therefore, we cannot just wish it away. I know left liberals would love to do it, and Julien Freud spent part of his academic career in France fighting exactly that. But the reality is, it is a second-person event, or sometimes third-person event if you're a public person and you find all these keyboard warriors against you. No matter what you do, they're in conflict with you. Less important than what's going on in the world right now. In the case of China, it's very simple. It's the document number 9, which everybody can read online from 2013, penned by Xi Jinping, which defined the Western values, Western institutions as existential threat to the survival of the Chinese Communist Party. So they took upon themselves to define that. And we, of course, coming from a liberal market perspective and commercial rationality, tried not to see that happening. Hopefully it's not too late to recognize where we are. So that's what it is about adversarial relationship. And I strongly recommend for anybody who's interested in this, if not reading Carl Schmitt, at least Julien Freud.
I hear there is a bit of a resurgence of Carl Schmitt, at least in the,
there is.
In the US, right? I understand that you had to cut a section on deep sea mining from your book. So, for the deep sea mining interested audience who's stuck with us this far, how do you put the seabed minerals into the picture that you kind of paint elsewhere around mining? Is it inherently different? Is it kind of just the same story over again? What's your view on this?
That's a very interesting question. How different is it? So one difference is that wherever you go on land, you're going to be under sovereignty of a state, with two exceptions, I think. Birta Whale between Egypt and Sudan, and Mary Birdland in Antarctica, which has no claims, strangely. But in the high seas, it's not like this, right? We, of course, have UNCLOS and no state sovereignty over large swaths of both the sea resources and deep sea under geological resources. So that makes it different. I think, first, why I cut it out from the book. The book was almost 800 pages long, and an agent said that it would never sell and that I should not publish such a book. So there are certain things that had to be reduced to its current size. But the reality of this challenge is that the technology is changing so quickly these days. And I'm thinking, for example, because of the conflict, certain technologies are advancing faster than others. Underwater drones are one example in Ukraine, and the control that Ukraine has over the Black Sea, unthinkable 4 years ago. And therefore, there's going to be more access, at least to a certain depth, than we imagined, even a year ago when I was writing this book. I think the biggest, of course, event is Minami Torishima right now, with those riser pipes that Japan has installed there. But the warning here is this is still a very heavily subsidized endeavor, right? So hoping that this is going to create, some low-hanging fruit with easy money, it's probably for the day after tomorrow. But it will come sooner or later. And if the question is what technologies will bring it up, that's beyond my pay grade. I wish I knew that. Technologies are changing just too fast for me to keep up now, much less project myself to the future.
What about the message that, China is also gunning to win the deep sea minerals race, and that they're out there trying to, I guess there's two messages with China. One is the kind of dual use, that a lot of the marine mineral research is also strategic resource in other ways. I had a short podcast on that earlier, but if you wanted to kind of add some color to that, I think that would be interesting. Yeah. And then there's also, sorry, just to put both questions at you, then there's also just the question of, is China going to become the first country to have the technology, and then they're going to also control one more large source of resources? So
I don't know if there's going to be the first one, because eminently Japan is the first one, and maybe Norway, the close second. But, China is somewhere out there, of course, plowing a lot of resources into those 3 state-owned enterprises that are active in this space, Minimetals being one of them. I think you're right about the dual use. Anti-submarine warfare is of critical importance for A2AD strategy, a Chinese military strategy in the Western Pacific and beyond, indeed. And for us, it means the coordination between the Japanese Navy and American Navy has to be very tight in this space. And much of the benthic studies more about anti-submarine warfare than any geological research. Having said that, China has put ahead on Clarion Clipperton around Kiribati, still the 11th largest EEZ in the world, and is very active there. Does it mean it's going to be the first, the second? Maybe it doesn't matter really, because the EEZs of other countries, not, of course, France first, but also US and Japan in the Pacific are considerable, and so there is space for other players as well. I think it's more concerning the political decisions some of the minor Pacific islands are making, and this is often part of those deals, and including, say, Cook Islands and some others. So there's always a fear of another Solomon Island flipping their allegiance, and it's a strategic problem for Australia, New Zealand, and other countries there. But it's a different story.
That's interesting. Sorry, can you put more color on that? So the concern there would be that the Cook Islands is trying to get deep sea mining going in their economy. It's like one of their options. And you're saying that if China steps in and helps them do that, then it pulls the Cook Islands into China's orbit. And then that itself is just a bigger strategic problem than actual China having access to their minerals.
It almost already happened in 24. I haven't really followed those events since then. But it was interesting to see an engagement of a Cook Island flagged vessel in Baltic Sea. So Unfortunately, the waters are connected. I mentioned Baltic Sea because it's just as shallow as the near shore of China. And interestingly enough, the choke point theory is currently being rewritten, given that Hormuz Strait possibly killed the Malacca dilemma for China. That if someone wants to hear more about it, it's on my podcast, Tyranny Today, the most recent one. But the reality is it's connected. It is connected. If you think about 1905 Japan-Russia war, who was fighting at Tsushima against the Japanese? The Baltic Fleet, Russia's Baltic Fleet. Just spent a lot of time going there. So the difference between these challenges and the challenges on land, whether you have access to specific mineral, say in Malawi, this is slow-moving story. In the high seas, it's a high-moving story with a lot of vulnerabilities, starting, of course, with internet cables and pipelines that can be ripped really easily and are defended with difficulty.
This is interesting. This is something that I haven't heard before. So in terms of the dual-use narrative, it's, been brought out that, okay, so maybe one of the reasons that China is out there doing research is because they're able to get advantages in submarine warfare. But yeah, this idea that control over deep sea mining rights or territory outside of control of the actual minerals, but just control of the territory, control of the influence that comes along with that would be valuable in this broader strategic way. I don't think I've heard that narrative being kind of put out there in the ether. Okay. Well, Thomas, I've got a million questions that I could ask you, but I want to be respectful of your time. So is there anything that you would mention before we start to wrap up?
No, I think it's worth paying attention to this sector. As I said, there's a lot of visibility for investors for years to come. We are in this pickle. It's going to take a lot of capital to dig us out of that. Some of this private, some of this, as we see already, taxpayers' money being thrown at it. I can be critical about some of these moves because I don't think it's the government's role to actually do this directly. But it's better than nothing, and it sends a signal to the market that this is a really, really critical part of our economy. So I'm very hopeful about it. And in the meantime, I do think that it's important to understand why we are where we are, and hence the need to read Mineral War. Which is still fairly topical, at least until November, where the reprieve from China will run out, and we'll see what happens later.
Okay, Tomasz, thanks so much for your time. Listeners, thanks for sticking with us, and now go off, pick up Mineral War. I can't recommend this book enough. It's also very readable for those of us with shortening attention spans. It's written in a great style of a bunch of short sections that each of which have a kind of a clear point. And I thought that was really helpful, that you've got a lot of messages. There's a lot of content. It's very complex, but it's done in kind of bite-sized pieces so that those of us who need to reread a section to get an argument can do that. Also, go listen to Tyranny Today, Thomas's podcast, where he explains the current machinations of the world in all of its facets. Thanks, Thomas.
Thank you, Eric.